Hey everybody, Jay Alexander here with Homestar Financial. Big day today, supposedly. Today's the day we'll have the Fed meeting conclude, and we're expecting another three-quarter basis point hike. So we're expecting the Fed funds rate to go up another 0.75% today. I get a lot of questions on that, a lot of concern, rightfully so, from people, especially being in real estate, being in the mortgage side of things. Hey, should I be freaking out? What's going on? What do we expect? So I wanted to put this information together and kind of give you an idea of what I'm seeing and what I expect to happen in the market moving forward. And so anyway, let's jump right in. So the first thing to know is where we started and where we're at now. So again, the expectation today is that the Fed will raise rates 0.75%. They did that last month back here on June 15th. The Fed rate was raised 0.75%. And then we've got, after today, we'll have three more Fed meetings this year, one in September, one in November, and then the last one in December. And the Fed has already told us they anticipate raising their benchmark rate another 1.5 to 1.75% between now and the end of the year. Obviously, today's meeting will take care of 0.75 of that. It'll take care of three-quarters of that rate increase. So we are anticipating an additional point increase from after today through the end of the year. Does that mean we get a half point and a half point at the next two meetings and nothing in December? Does that mean we get a half point in September and two quarter point hikes in November and December? No one knows. I think we'll have a lot more economic data between now and then that'll help us figure that out and project it. But the biggest thing to know, guys, is if I can put this together on a slide and I know this, then everybody in the marketplace knows this. And what I mean by that is our rate sheets that we have here in the mortgage business, your expectations for companies with quarterly earnings and reports and things like that coming out over the next several months through the end of the year. These rate hikes are already anticipated and priced into what we're seeing in the market today. So the question really isn't, oh God, rates are going up three-quarters of a point, what's going to happen to mortgage rates? Like I said, that's already priced into our rate sheet. The real question, I think the better way to try to figure out what's going to happen in the marketplace is to look at what's happened historically. When the Fed goes through a series or through a period of time where they're raising rates, what do we typically see? So, let's look back in history here. So first thing is during the 80s, when we had Chairman Volcker sitting with the Fed, inflation had started to spike. It went from 7% to 14%. Mortgage rates had spiked. They went from 12% at the time to 18%. The Fed funds rate went from 11 to 20 during this time period. The response was that inflation came down from 14% to 5%, and mortgage rates responded favorably. They went down from 18 to 12. However, the S&P did go down and the economy entered a recession. That's what we experienced. Back during the Alan Greenspan era, this would be during the dot-com boom and bust, inflation started to creep up. It went from 1.75 to 3.5%. Mortgage rates went up, again muted because the response wasn't quite as significant, from 7% to 8.5%. Greenspan went through a series where we raised the Fed funds rate from 4.75 to 6.5. Inflation responded favorably, went down from 3.5 to 1, and mortgage rates responded favorably, went from 8.5 to 5.5. But again, the consequence was the S&P was down and the economy went into a recession. Now let me turn my video off here so you can see this next one. Here we are, Jerome Powell's our current Fed chair. We've seen inflation go from 1.75 to about 8.5, where we're at today. Mortgage rates have obviously jumped up. We were at 2.5 at one point in time. Now we're somewhere, a little bit better than that maybe today, but we've been up as high as the sixes, maybe even higher on investment properties and things like that. Currently, the Fed funds rate is 1.75 with a target by the end of the year of 3.25. In theory, we should expect inflation to drop. I don't think we'll see peak inflation probably until the fall, but we should see inflation drop. And as a result, mortgage rates should respond favorably and should drop as inflation drops. Obviously, the consequences to that, and we'll see, there's debates out there right now with, if you listen to the economic news and the Treasury Secretary Janet Yellen, are we going to be in a recession? Are we going to avoid a recession? Who knows? But this is what we're seeing in the marketplace today. And in general, when the Fed raises rates, we typically raises their Fed funds rate, we typically see mortgage rates go down. And actually looking back historically, this is a chart, a lot of noise and data in this chart, but the data I want to point out here, the yellow line is the Fed funds rate, or orange. If you're colorblind, I apologize. But this orange line right here, you can see right here, let's just go back in time, rates, the Fed raised rates here, and then the blue line is mortgage rates. We can see mortgage rates trend down after the Fed raised rates. From here to here, from say over time from 1995 to 2001, the Fed raised their rates, and you can see as they raised rates, mortgage rates went down. We raised Fed's rates, mortgage rates go down. We raised Fed rates from 2005 through about 2009. Mortgage rates dropped down. Well, now we're in a period where mortgage rates have shot up. We're starting to see the Fed raise their Fed funds rate, and again, the expectation will be that these mortgage rates will continue to creep down and turn a little bit more favorable as a result of the Fed raising their Fed funds rate. And the biggest reason for this, guys, there's lots of reasons, there's lots of indirect impact that happen, but the best way to explain it, I think, in a short period of time is to understand that the Fed funds rate is a short-term interest rate. It's the rate that banks borrow money from each other overnight. A mortgage interest rate is typically fixed for 30 years, so it's a much longer-term rate. So you can't compare apples to oranges when people say, oh, the Fed's raising rates, my mortgage rate's going to go up, or mortgage rates are going to go up. That's really just not true. There's a lot of things that affect our mortgage rates, but generally speaking, the Fed raising rates does, over time, cause our mortgage rates to come down. Now, obviously, the higher rates in the marketplace right now is affecting the overall demand for housing. And at the end of the day, housing is always governed by supply and demand. So let's just real quickly recap that, because if we're going to talk about mortgage rates, inevitably we're talking about the housing market as well. So let's look at a few data points here. So first off, let's hit on the demand piece of housing. Generally speaking, everybody that's alive has to have somewhere to live. And I've showed this chart before on a previous video, but you can see back here in 1973, we reached a year where overall birth rate in the U.S. had gone down and stayed flat before it started to rise again. What's interesting about this year is you add 33, 35, the median first-time home buyers, usually between 33 and 35 years old. Those home buyers were all, 33, 34, 35 in 2006, 2007, 2008, which was the beginning of the drop-off in demand for housing, which led to overall, the real estate crash that, we all experienced, or most people that are in the industry right now remember from, about a decade ago or so. In today's world, though, that all of the people that are driving the demand, a lot of our first-time home buyers, these are a generation of people, it's our millennials that were born in the mid to late 80s, maybe early 90s. And you can see here the population growth in the U.S. has only steadily gone up, and we have several more years of steady population increase before it starts to slow down just based off birth rate data that we have. So the demand is there. Everybody has to have somewhere to live. Obviously, there's lots of things that affect that demand, but I would argue that some of the recent things in our history, specifically with coronavirus, more people working from home, people realizing they don't have to drive multiple miles every day to commute to work. That's actually increasing the demand for housing, because people can buy a house, stay at home, be there more often, and not have to have apartments or places closer to cities where they have a better commute to work. So overall, I think housing demand is there. There's lots of people looking for houses. They're just looking for the right time. Certainly, rates going up effectively causes the price to own a house increase, and it might slow down demand a little bit. But like we've already said, we do expect rates, over the next several quarters, if history holds true, to come down. So I think demand is fine. I don't think we have a demand issue or just a lack of people for the houses that we have. Now, when it comes to supply of houses, I think this is an interesting chart. These are the housing starts. We have data for that all the way back to about 1960. And the key data point I want to focus on here is at the tail end. Obviously, housing starts spiked up in the early to mid 2000s. That was the extra supply that created the housing bubble. It was a combination of increased supply plus, like we've already showed on the previous chart, decreased demand, as we just didn't have as many people entering the market to purchase homes in that time period as we had previously. Well, as a result of the financial crisis and the credit crunch that happened, many builders bowed out of the market. They quit building new houses. Housing starts plummeted and stayed extremely low for an extended period of time. And we've only just recently caught up with housing starts up to kind of what I'm going to call a midline from this data. So, and anybody in real estate right now will tell you, look, yes, it's an interesting market, things are shifting, but at the end of the day, there's just still not a whole lot of inventory on the market. There's more than there has been in the last 6 to 12 months. It's certainly a little bit better for buyers out there, but at the end of the day, there's just not a lot of inventory. So the demand is strong. The supply is trying to come online to meet that demand. Obviously, there's some supply chain constraints. A house now is a product. It's a global product with items in it that are manufactured and created all over the world. And fortunately or unfortunately, it does help the price of houses. But having items in your house that have to be manufactured in China and Taiwan and different places that are then shipped over here to complete your home or complete the home building process, that supply chain is strained right now still as a result of coronavirus. So overall supply, I do think will eventually catch up, but when you have limited or lower than normal supply along with consistent demand, that is indicative and should trend towards stable home or even steadily increasing home prices. And then to back up that point, I've got one more chart here I want to show you, and I found this chart fascinating. Right here, we've got the average price of homes in Atlanta, okay? So the blue line is the average price of homes in our Atlanta market. You can see here we go all the way back to 2002. This price point here from 2002, obviously it shot up during 04, 05, 06 at the beginning of what ended up being the real estate crunch or the mortgage debacle or whatever you want to call it, the Great Recession. Obviously, home prices came down, stayed low and depressed, and then since then they've gradually been increasing to where we're at now. What's interesting is if you look at the average price of a home back in, say, 2002, approximately $165,000, and you run a 4.5% appreciation annually for that house all the way till today, prices are just now getting to the number that they should be had homes appreciated at their normal kind of 4 to 5% appreciation rate that we expect in real estate. Now, I have to admit, even for me being in the industry, when I saw this number or when I saw this chart, I wasn't exactly sure that I trusted it or that I believed it. So I'm going to show you exactly what I did. I fired up our trusty search engine here, Google. I typed in appreciation calculator, click this button right here. Obviously, they tell you all about appreciation and how it works, but you have an actual calculator. So I put in, okay, let's say I bought a $150,000 house in 2002 with a 4.5% appreciation rate annually, so yearly. And now obviously it's 2022, so I would have owned that home for 20 years. $150,000, 4.5% appreciation over 20 years gives me a final value of $361,000. Go back to this chart over here. Sure enough, 150, 4.5% appreciation, right at 360, right where we're at on the chart. So I would tell you that housing at the end of the day now is a great time to buy a house. Yes, there are a few less buyers in the market. I'm seeing more concessions on the seller side. You can negotiate and maybe get a little bit better price, get some concessions perhaps to buy your interest rate down. Assuming mortgage rates go down in the future, you can always refinance. But I don't see a scenario where home prices plummet and fall back down to the levels that we experienced, 7, 8, 9 years ago. I just don't see that happening. There's too much demand in the market for that. But understand that when rates inevitably do come back down, I do think it will happen for lots of other reasons, and there's other things we could cover in this video, but I do think we're going to see over the next 12 to 18 months mortgage rates go down. What that's going to do is that's going to pull more buyers back into the market, and we're going to be right where we were, maybe not like we were during the height of it 12, 18 months ago, but we're going to be right back to the scenario of multiple buyers competing for the same house, appraisal gap language, and how much cash do you have and what can you offer the seller. I think now is a great time for buyers to take advantage of this opportunity in the market. Find the right home, buy the home, and then when the market gives it to us, we can always go back and refinance that mortgage and take advantage of the lower rates, and you'll be in a home that should be worth more money. So that's my thoughts on the market. That's my thought on the Fed funds rate going up. That like we said, we're already anticipating the 0.75% increase today. We'll definitely digest what the Fed has to say about all this, because what the analysts, what everybody looks at on today is their press release. We look at what the Fed actually says about the market and what they're anticipating moving forward to try to get an idea of how to anticipate the Fed's next move, and then obviously adjust rates and balance sheets and asset holdings accordingly. Certainly, guys, if you have any questions about this, you can always give me or my team a call. I've got the number on the screen right now. Love discussing economics and how it works and how it impacts you. And certainly, if you're looking to purchase a home, looking to refinance, maybe take cash out, we can certainly help you with that. Hope you enjoyed the video, and like I said, with any questions, please give me a shout, and we'll look forward to talking with you next time.